Good afternoon, everyone, and welcome to Stock Market Today. It's Coram and Ed Carson here with a breakdown of the action in today's session. And breakdown is very appropriate for what we saw today. Ed, stocks really taking a hard hit today. We had more economic data out, but earnings from several big players like Home Depot really weighing on the market today, with the major indexes breaching key levels of support.
Key levels and more big levels to come. And Treasury yields are a big factor, and we'll go over all of that. I want to take a look at Autoliv, Wingstop, and Weston.
Okay, we'll take a look at those three stocks, but first, let's analyze the major indexes. The NASDAQ today down 2.5% when all was said and done in today's session. Harder hits still were small caps, with the Russell 2000 down 2.8%. We also had the Dow off by 2.1% and the S&P losing 2% today. So big hits all around. We saw a pullback starting in early February that at first started to look, it was pretty textbook, pretty normal, pretty healthy. But on Friday, when we touched that 21-day moving average, it started to seem like we could be at a crossroads, because a break of that level is not something that we'd want to see in a strong rally. So that test, as of today at least, has failed.
Yeah, that isn't great news. I mean, on a weekly chart, just briefly look at that, you could argue, well, it's still normal. It's not necessarily healthy, but it's sort of like if somebody's blood pressure rises, but now you're at the high end of normal. I mean, it's sort of like, well, you might want to cut back on the sodium, even if you're technically normal. I mean, this could end up being healthy, but at the same time, we are coming down to key levels. We are getting close to more that area, like is it under the 21-day line and the 200-day line for the NASDAQ and other major indexes, from levels for the S&P. Definitely needs to find support here. Investors, I think, definitely should be taking more of a defensive tone, even if they're not explicitly cutting their exposure. Just cutting back. You stop doing new buys because there's not many buy signals, and then you cut out some losers, and you maybe take profits on winners that are either extended or rolling back. So we'll see how it goes, but this is definitely an important time for the market.
Yeah, you make so many great points, Ed. I also think it's important for investors to know what market conditions are, because it impacts portfolio exposure so much. You don't want to just be looking at stocks in a vacuum, just like it's not a good idea to be adding into strength when you start seeing vertical action, when the market is getting pounded, for lack of a better word. That's also not a good time to be adding exposure. So really bending with the conditions that are presented and keeping an eye on those technical levels can't be understated enough.
Yeah, I mean, that's exactly right.
All right, moving on, let's take a quick look at some of the other major indexes. So we have the S&P 500, while it too also was hanging on right around that 21-day on Friday. Looked like it could be encouraging, but as it turns out today, not a good day. So clearly undercutting the highs from late November, early December, mid-December as well. Below that round number at 4,000, getting very close to that 50-day line. So more key technical levels coming up, as you mentioned, Ed. And if we draw a trend line from the lows, maybe we do have a little bit more room to the downside. And like you said, this could be healthy, but that doesn't mean that we just sit there with full exposure while we're seeing this play out.
Yeah, and I do think, and I agree with everything you're saying. Now, the 50-day line for this and the 200-day for the NASDAQ so important, and then the 200-day line, if we break below that, we're really giving up almost all the gains from the January 6th follow-through day at that point. Would really be discouraging at that point, and so decisive move below there, which we could do in one day. I mean, we could have another day like this, and we are below the 200-day line on the S&P.
Yes, because we closed 1.4% above the 200-day line today. So yeah, it really wouldn't take much. And Ed, going back to just what we saw today in terms of what expectation that leaves us for what we could see tomorrow. And of course, you get one or two headlines and that, or the 10-year yield does something and that changes everything. But based on technicals alone, when you see a day like today, we expect more weakness to follow, right?
Yeah, I mean, we've had the, you sort of expect trends to continue until they don't. And we've had, and this was the third straight day and a heavier one too. So you would expect that, and you'd also be cautious about any rallies. Okay, we could rally up. What if the 21-day line may now start being resistance?
Yeah.
I mean, because you drew those lines, there's a lot of trading that peaked around there, so you could see that. So I think you want to see real strength on the flip side. Yeah, it's a dangerous time right now.
Okay. And now let's also take a look at the Dow. We were saying it was building a trading range. Which way would it break? And it broke lower.
Yeah, first time, and basically you can finding support doesn't mean it'll keep doing it. It was basically for a full month it tested that 50-day line, and boy, it looked good in that regard, but it couldn't do it now.
Mm-hmm. And small caps will also check in there. The 21-day line for the Russell, like the Nasdaq and the S&P 500, had been a key area of support basically since that follow through day, and a big move below that level today that also coincides with a breach of those highs from late last year.
Yeah, I mean, it's the same pattern across the board. So yeah, it's all sending the same signal.
Mm-hmm. And like you said, with the Nasdaq, taking a step back on the weekly does give you a different perspective. We were saying just how stunning, honestly, it was to see the market go so high so fast on. I know, as you were saying, basically like a mediocre at best mixed headlines. So really, how long could that be sustainable? I guess we're getting a little bit of a dose of reality here today, Ed. We're not out of the woods yet.
Yeah, and we'll have to see if this is just going to be a more serious pullback. Again, it's undecided, but it's clearly not the strong rally we were seeing in January.
Mm-hmm. But as always, traders have to be flexible, reacting to that real time data that we see on the charts, whether for positive or better or worse, shall I say. Bullish,
right.
bearish, positive, negative, better or worse. We will remain flexible. Let's also take a look at some other charts that provide perspective on the action that we're seeing. In addition to all the things that I mentioned at the top of the show, yeah, I mean, this is probably the biggest factor, would you say, Ed, that was weighing on stocks today?
Yeah, and has been for a while, because it's no coincidence that the market peaked on February 2nd, which is where the Treasury yield bottomed. I mean, like so we are now at 2023 highs. We hit resistance there on Friday. It's no surprise. That's when the market bounced on stocks, and this time came right through it. We're highest since November. Really closing in on 4%. I think the market's pricing in at least another rate hike. And a few weeks ago, we were thinking, well, maybe there'd be one more.
Mm-hmm.
And now it looks like it's probably going to be three more. And Friday's PC inflation gauge may be very important to sort of set a view of where inflation and where Fed outlook is going to be for the next few weeks.
Okay, so we have that to look forward to.
There's always something, isn't there? Yeah.
Week. There's always something. Always something. Okay, and when you see the yields go up, you also, we're seeing the dollar up here too. So anything else notable here that we're seeing, Ed, in addition to just that inverse correlation between stocks and the yields in the dollar?
Pretty much the same thing, and the yields in the dollar sort of put some pressure on stocks.
For sure. And now let's take a look at some of the groups today underneath the surface. Here's XME, the metals and mining ETF, underperforming here, down 2.6% by the end of the day. So worse than the Nasdaq's 2.5% loss. Your thoughts on how this group is kicking off the week?
I mean, it's not great. It's still holding the lows from a few days ago, but it is this time the steel makers, which were clearly the leaders in this area, they slumped for various reasons, while some of the miners held up. So it's definitely have to dig in there. But yeah, it's not terrible. Look, one or two good days, and all of a sudden this looks great.
Right.
One or two bad days, and this really does not look good at all.
Mm-hmm. So a very delicate situation that we have in the works here underneath the surface. Here's SMH, the chip ETF, it also was finding support at that 21-day line until today. And so an even bigger hit versus the broad market with the chip sector down 3% today.
Yeah, and NVIDIA earnings are tomorrow. It's one of the largest components. So that'll be important for the chips, for the rally, what they have to say. They just have to. So that's something to know. It's probably the biggest earnings report of the week.
Okay. And now let's take a look at the VIX, 0 VIX on MarketSmith. So this fear gauge ticked up a bit today. And, something that we were talking about recently is sort of the level of complacency that we were seeing in the market. So is it a good thing that we are seeing to see some fear creeping into the market, or does that spell more destruction before the lights at the end of the tunnel there?
I think it's a positive thing. Look, if that had stayed low while we were coming down, it's like, oh boy. But that goes to that whole thing about we were rallying on not great news, and it just felt like, yeah, everything's going to be fine when it really wasn't. I mean, in some ways, I'm not saying it was terrible, but look, we're way below the levels where you would see it, say, at a correction kind of thing or kind of situation. But if this is just a pullback, maybe all we need is a little, that's some kind of that extreme complacency to come off. So, I don't want to try to measure it, but it's just nice to see that it coming up. I don't know where it'll peak. That'll have more to do with the market, but it's nice to see some of that come off.
Yeah, it looks like the previous point for the VIX on the follow through day so here's the 5th and 6th. It's now getting back above that level. So a rally or follow through day high there, post follow through day high for the VIX. All right, and now let's take a look at some notable movers up and down in today's session, including ALV Autoliv. This is a stock in the number 22 group out of 197. It was looking promising as the day kicked off. It did reverse lower, still weathered today's storm better than many stocks, but even stocks that are trying to lead coming under pressure here.
Yeah, that's why, even though it seems like an area that seems to be doing pretty well, the group is doing well, you could have drawn something there, or you could even draw something really tight if you wanted to and get into it. I mean, start an early entry, but it didn't work. It just wasn't a great day for it. It's part of this big cup of handle, but there's also a bottoming base that it sort of came out of previously. So you could sort of see this as a shelf, lots of different ways. There's a lot of stocks that have looked like this one way or another. And technically it could be actionable already just from that. But yeah, it's one you watch. This group is one to watch. But it's just tough for anything to make headway. I mean, when the NASDAQ is down 6 percentage points in 3 days, it's really hard to get going.
Right. And something that we've said previously that I think is worth repeating is that just because a stock flashes a buy signal doesn't mean that you need to buy it. And I feel like the biggest factor in that is knowing what kind of market you're in. I know, Ed, when you're on IBD Live, that's something that you bring up a lot for a good reason. If there are stocks that are looking actionable, you're always pointing out, but look at where the market is at. Is it really a good time to be thinking about adding exposure? And I think that's a really great reminder.
Yeah, and also you have to remember yourself. If you're going to be jumping in and trying to dance around, kind of things, you have to be able to jump back out. So
yes,
know your own trading strategy.
So true. And yeah, I feel like I wish I would have done an even better job taking profits into strength in this rally. Something that it's like we had to wear our short-term hat for so long in 2022. I was really hoping, to get some extra juice out of some stocks, and maybe taking some profits into strength even more is not a bad idea. So some food for thought there, at least for myself. All right, let's take a look at Wingstop. It's holding up with earnings due. It did take a hit today, down 4% to close below a buy point. This was a strong looking breakout that we saw early last week, and that is now being tested with earnings due. And if you look at the volume trends here, we have this downside reversal off highs, or maybe not. I don't know. Is this an all-time high? I guess it's close.
Very close.
Highest Highest levels in a long time was a downside reversal in the heaviest volume in a number of months. So maybe a little bit of a warning sign there, Ed.
Yeah, maybe, and definitely today. There's no doubt about it, because at least that other day was okay. It didn't fall too much, but but today definitely. So 2 high volume days. The highest volume in the consolidation have been these negative losses. So it's tough. I mean, if you bought it recently, even if you bought it off an early entry, just off the 50-day line, you don't have, you just have to, like, that's a little bit, you could probably do it, I'll hold it off of that. But if you bought it fairly recently, you're either down or just up a smidge. So
With earnings due.
with earnings, they're going to be coming out tomorrow morning, and you just don't know. I mean, you'll either look like a genius or look like a fool, kind of thing, when it's really, you just don't know. And usually, if you don't have a gain, it's most people, CanSlim investors, they step to the side or do it as an option play. But just if you do hold it, hopefully it's not a big position, so it doesn't really hit you tomorrow if things go badly.
Mm-hmm. Well said there. And let's check in on a defensive name that's been flexing its leadership muscles, and that's Weston, the food packaged group. Not a high ranking group, but this is a high ranking stock. And it's been able to hold super tight right at this century mark, Ed. So all in all, really showing its strength today when a lot of stocks got hit really, really hard.
Yeah, and that relative strength line was falling early on during that consolidation, and now it's rising, and the stock is going nowhere. But that's a reflection of the market a little bit. And one reason I want to bring it up is that there was others. I mean, there's more of a defensive bent today. Hershey's HSY, just want to briefly go. That one almost broke out today. So I mean, and that one has pretty good earnings, just like Weston. And so people are going, well, people are still going to get French fries. They're still going to get potato. They're still going to get chocolate.
Campbell's making a move today.
Campbell's made a move. General Mills had positive guidance. So there was like people going to food. Now, maybe there were some things about maybe price hikes, or they thought that there was still demand. In any case, Weston is probably one of the better looking in the bunch because it's so smooth. It's showing that real strength in there, where the other ones came off for a while. The earnings will eventually fall, but it was a really strong fiscal year it's got. I mean, probably the growth is going to slow the next couple of quarters, but still an impressive performance. There's a lot of growth stocks that would like 14% growth in the next fiscal year. So definitely one to be paying attention to, but it's also not necessarily the greatest sign for the market that packaged food and confectionery is showing relative strength right now.
Yes, very craveable for investors, perhaps. But what about where this stock is in its move? I mean, from the spring of last year, it's doubled. Does it feel like it has more room in it?
Well, part of the issue is if this market, doesn't do if the market doesn't do well, it's hard to see it going up. And if the market does well, will growth stocks take over? Yeah, and so it's hard to know if this can really make another move. Obviously, you could have said that before. I mean, that's sort of how was my thinking the last time it broke out, and then it just marched on higher. So yeah, it could still make another run. You probably don't want to be making huge bets on that, because it's hard to say how much. You sort of need a sort of weird kind of market conditions for it to really lead. But it is doing well. It is holding up, has been holding up well during all this period.
Yeah, so we definitely can't ignore it. So Here we are talking about it. All right, just like I can't ignore my craving for French fries, right? But I have been keto for like almost a month now. So
yeah, I just have to stay away completely from any of that places. I can, you put a pile of French fries in front of me, I'm not going to stop.
All right. Well, thanks, Ed, for your perspective today. And thanks, everyone, for tuning in. We'll be back with more tomorrow morning on IBD Live. So please join us. It's going to be Wednesday already. But we've got your back, investors.com/live FAQ for all the details. We'll see you there in the morning. And we'll see you right back here tomorrow after the close.